Good afternoon, everyone. My name is Barbara Kalarjan. I am the Director of Development for the Diocese of Rockville Center. Welcome to our first webinar of the new year, Tax Strategies for 2023. Before we begin with any of the introductions, we just want to go over some housekeeping issues. This webinar will run for about 1 hour. We will allow for questions at the end of the presentation. Your mics have been muted. Please make sure if they're not that you mute them yourselves so that we won't have any feedback. You can submit your questions by typing them into the Q&A window. It's provided on your Zoom toolbar, and we'll try to address all of your questions. At any point you're experiencing any kind of audio issues or video issues, please send us a message via chat. We have a brief survey at the end of the presentation, and we hope that you will please fill that out. It really helps us in serving you better and coming up with new webinars to feature. This presentation will be recorded, and we will send you a link a few days after the presentation. Now it is my pleasure to introduce Mark Henry. Mark has a background in law, accounting, and finance. He is an attorney and CPA for 30 years, has been serving the Catholic community. Mark wrote a book called Finished Faithful, which explains how faithful Catholics can leave a lasting legacy through wise planning while helping their families and using tax-wise strategies that help the church continue its important work into the future. Mark serves as a stewardship advisor to the Diocese of Rockville Center and is available throughout the year to help you with any questions that you might have about estate planning. Thank you, Mark.
Well, thank you for that introduction, Barbara. And I'm pleased to be here for the second in a series of webinars where we will be covering topical areas of interest to parishioners in the Diocese of Rockville Center. Many of these subjects will relate to areas of interest of seniors, including estate planning, tax planning, and long-term care. And we are fortunate to have with us, joining us in the webinar, Vincent Russo and Marie Puma with the firm of the law firm, the Russo law firm, who has offices in Long Island and in New York City. We have a lot to cover today, so I will just turn things over to Vincent.
Thank you, Mark. Again, it's really a privilege for Marie Elena Puma and myself to be part of this program, Tax Strategies in 2023, and to partner with the Diocese of Rockville Center. Quite a privilege. Today, we're going to focus in 3 areas. We're going to provide you with a tax update on gift and estate tax exemptions. We're then going to discuss with you tax saving strategies with IRAs. It's a complicated area, but it's an area where tremendous benefit can be received. And then lastly, making the most of charitable giving. And there's some really wonderful opportunities to be able to support the church, your local parish, while creating tax savings for yourself and your family. So with that, we're going to jump into the first segment, which is tax updates on gift and estate tax exemptions. Each year, the federal estate tax exemption and gift tax exemption is adjusted. There's in effect, like a COLA adjustment. And so the good news is the exemptions go up each year based on those adjustments. And we want to give you the latest information there. So with that, Marie Elena, why don't you introduce the topic of how to approach estate tax planning and then give us the update.
Sure, absolutely. Good afternoon. So the first thing that you have to do when you're making a decision to move forward with estate tax planning is determining the size of your estate. A lot of people don't realize how large their estate is. So that's very important to do first. Number two is to understand what the estate tax rates are and the exemptions, both for the federal government and for New York State. Number three is to consider what tax saving strategies and techniques are available for you, and that would work to meet with what your intentions are. And then number four is to then implement a plan that works for you. So we're going to start by looking at what does your estate consist of. And when I meet with clients, I ask them to do this exercise in advance of our meeting, and then we go through it together because they don't realize the actual size of their estate until they actually sit down, put pen to paper, and start to look at all these things. So you have to look at everything that you own: real estate, bank accounts, cash, annuities, brokerage accounts, savings bonds, life insurance policies, retirement accounts and pensions, cars and boats and other vehicles, your jewelry, your art, other collectibles. And you put this all together, and that comes up with your assets. And it doesn't matter whether you own that asset individually or if you own it with somebody else. You have to take into consideration whatever your interest is in that asset. And then you look at your debts. Do you have a mortgage? Do you have a loan on? So recently I met with a client who has a small yacht is what they called it, but there's a loan on that. So you have to look at those types of liabilities that you have, and you subtract that from your gross amount of your assets, and that will give you a good indication of what the value of your of your estate is.
Hey, Marie Elena, I
Yes.
noticed that you have on the list life insurance policies. And so why is that on the list? Many people believe it's tax-free.
So life insurance so tax-free meaning income tax-free. So I think that's what you're getting at. So life insurance policies are income tax-free. They could be estate tax-free if they are funded into an irrevocable life insurance trust and those eligibility requirements are met. But they are also a part of somebody's gross estate if they are not planned with. In other words, if you don't put them in a vehicle such as an irrevocable life insurance trust, they will be considered part of your estate.
So the death benefit is the amount that would be included in the estate?
Correct.
Okay.
Okay, so now that we know what your taxable estate is, let's figure out, well, what is a taxable estate and what is going to be subject to tax, and what are those percentages and those amounts. So we're going to start with federal, and we're going to look at the top estate tax rate. So the top estate tax rate for federal is 40%. That's a huge, huge percentage. For New York State, the highest rate is 16%. New York starts at 3.06% and goes all the way up to 16%. The estate tax exemption for the federal government is now, as of 2023, $12,920,000, and New York State, as of 2023, is $6,580,000. That is the amount of assets that you can have before you have an estate tax for the federal government or for New York State. New York State has a little difference than the federal government. We have a cliff, and what that means is if the value of your estate exceeds 105% of the exemption amount, which so 105% of $6,580,000, so that number comes out to $6,909,000. It means that essentially you lose the exemption of $6,580,000, and your estate is taxable from the first dollar, starting at the 3.06% rate and all the way up to 16% once you hit $10.1 million. So we have this cliff, which basically can cause you to lose your estate tax exemption if you fall over that cliff and have more than 105% of the 6.58 number. So here we have just some examples to give you a sense of how do those percentages of tax rates play out with certain dollar figures. So we're starting at $6,580,000, and we know that there's not going to be a federal estate tax. and there's not going to be a New York State estate tax. So your total taxes in that example are zero because you're below the exemption rates for both federal and New York State. At $6,909,000, which we know is just before you fall off the cliff, you still have no federal tax, but you have a New York tax of $626,352. When you get to $12,920,000, you still have no federal tax, but now look at your New York tax, because you've fallen off the cliff at this point, and you're paying $1,534,000 in estate taxes to New York. And then as people's estates are even larger and you look at something like $20 million, now you're starting to get a federal tax at $2 million, just over $2 million. And you have an estate tax to New York State at over $2.5 million. So now you're almost at $4.7 million in your total estate taxes between federal and New York State. So you need to do some planning when you're in this situation, because it is just, you know, it's not, as Vincent says, why make Uncle Sam one of your children or one of the beneficiaries under your will, or a charity, quite frankly? Do some planning so that you can redirect those assets in another way.
That's right.
Okay.
Excellent. So that really frames it for us. Significant taxes, especially once you fall off the cliff in New York. It's kind of crazy saying, but that tax is really punishing. And so you can reduce your estate tax liability by charitable giving. And that's where we're going to focus in on today. And so just to frame it in the bigger picture, if your estate is in excess of $12,920,000, you should be doing federal and New York State estate tax planning without any doubt. If your estate is in the area of around 6 million, I would suggest that that's something you absolutely should be meeting with a professional estate planner and making sure that you're not creating a New York tax, or what strategies are available to avoid them. Now, we've talked about New York. There are some other states that have estate taxes as well. Most states either do not have an estate tax, or there's called a sponge tax, which in effect, there's no real adverse impact of the state taxation. So here in New York, we need to be mindful of these exemptions, the tax rates, and what it means for you on an individual basis. So I always like to talk about legacy planning. And while you're alive, there are a number of gift tax strategies that can save estate taxes. We're not going to cover them all today, but I wanted to at least provide you with the list that you could make gifts to trusts. Trusts are wonderful vehicles in many different ways, avoiding probate, asset management, protecting a loved one who has long-term care needs, or a drug or an alcohol problem, or is a spendthrift. Now you can combine those asset protection measures and benefits with tax planning through the use of what are called grantor retained annuity trusts and qualified personal resident trusts. You can also reduce the size of your estate using limited liability companies and having voting and non-voting units. You can save potential additional estate taxes as your estate grows through the use of a spousal lifetime access trust if you're married. For people of greater wealth, they may be thinking about creating a legacy for their family through a dynasty trust, which sometimes is referred to as generation skipping. And then, to me, most importantly, charitable gifting and the use of trust with charitable gifting. And so let's move into the world of retirement accounts. And we're talking about IRAs. And there have been some recent developments that Mark is going to address for us with the 2023 Omnibus Bill and the 2023 Legacy IRA Act. And we will always like to think of these IRA strategies in combination with charitable giving. Mark.
Yes, there have been some recent very significant changes, and just to kind of set the table here, in 2019, the Secure Act had some pretty significant legislative changes to retirement plans. And this most recent change, the Omnibus Bill of 2023, was just recently signed into law just 3 or 4 weeks ago. And it does contain a number of different provisions which are intended to encourage additional retirement savings. It also simplifies some of the administrative procedures, but basically just reinforces some of the incentives for retirement plans which were implemented in 2019. And some of the more significant changes are, well, most people realize that there's a time when they have to take distributions from their retirement plans. And those distributions are called required minimum distributions. Now, prior to January of 2020, required minimum distributions were required when a person reached the age of 70 and a half. The Secure 2.0 Act increased that age to 73, and that change has been implemented into law. And what that means now is that individuals who turn 72 in 2022, they must take their required minimum distributions by April 1 of 2023. However, if an individual turns 72 in 2022, the first required distribution must be taken by April 1 of 2023. And if an individual turns 72 in 2023, the required minimum distribution will begin in April of 2025. Now, also built into this omnibus bill is a provision which is commonly known as the Legacy IRA Act. And the Legacy IRA Act has created some incentives for charitably minded folks to fund different types of charitable gift planning strategies. Beginning in 2023, as a result of the Legacy IRA Act, donors can now use their IRAs to fund some type of life income gift, like a charitable gift annuity or a charitable remainder trust. Now, there are many different nuances here. It's not the most simple change in the tax law, so it's important that you consult an advisor. And this is something that the Russo Law Group firm can certainly help you with. But it does create some opportunities for donors who are looking to create a legacy gift and also receive an income for life. And I won't get into all the details, but one of the significant changes is that a donor can make a once in a lifetime gift election to fund a life income gift. And when I say a life income gift, that's like a charitable gift annuity or a charitable trust, but they can fund this vehicle with an IRA. This can be done in one tax year only, and that really wasn't permitted under prior law. And the aggregate limit of IRA funded life income gifts in that year is $50,000. And you can create a one-time gift of $50,000 in one tax year only. There are a few other details that are implemented in the Legacy IRA Act, and this is where it's important to consult an advisor to see if this might be a unique and helpful tax reduction strategy for you.
Thank you, Mark. This is, I'm glad you brought it to everyone's attention. These are late-breaking news. These are recent changes that are coming in play. And it's, as you mentioned, it's giving people an opportunity to have choices in how they can help a charity, and really maximizing what I call a win-win situation, saving taxes and helping a charity at the same time. So I'd like to just drill down a little bit on the use of charitable remainder uni trusts, sometimes referred to as CRUTs, C-R-U-T, because this is one of the vehicles now under the 2023 Legacy IRA Act, where you can utilize this trust. And what's great about this trust is that once established, you, if you're the one establishing it, you can retain an income interest for a period of time or for the rest of your life. So you can elect a fixed percentage of the value of the assets be distributed to you on at least an annual or more frequent basis. At the same time, upon one's demise or at the expiration of the term you pick, then the remaining balance of the CRUT assets would go to the charity. So it's giving assets away to help a charity while retaining an income interest. So let me give you an example of Mr. Smith, who's age 72 and has $1 million of publicly traded stock. And he wants to place that $1 million into a CRUT. And he wants an income return over his lifetime at 10%. So that's a pretty high number, you know, relative to what one might get in terms of investing the assets and receiving income from those assets. But he says, well, I'm going to put $1 million in, but I want to get $100,000 each year until I pass away. When I pass away, whatever's in that charitable remainder uni trust, I want it to be distributed to my favorite charity. And so this is an example of how a CRUT would work. So I took the liberty of just running some numbers. And if Mr. Smith was to set it up this way, he would receive back over his life expectancy, which is 12 years, almost $1 million. So the $1 million he gave away, he's in effect with that $100,000 a year is getting it back. In addition, he would get an immediate income tax deduction for making a charitable gift. And that amount is $342,800. And if Mr. Smith's in the 30% tax bracket, he just saved $100,000 in taxes. He's given an asset away that he's going to get back in effect over a handful of years. And in the end, the value of the charity, if that asset was returning 6% a year, the charity would end up with $600,000. Wow. He got $100,000 tax savings. He got his $1 million back over 10 or so years. And he also helped the charity by $600,000. It's a wonderful vehicle to consider if you have more significant assets to be able to gift. Now, Mark also alluded to the qualified charitable distribution rule. And so, Marie Elena, you want to talk a little more about that?
Yeah, absolutely. And I love this one, making qualified charitable distributions from your IRA. As we all know, every year you need to take your required minimum distribution. And every year when you file your tax returns, that's considered taxable income and you pay a tax on it. Well, the beauty of a QCD, a qualified charitable distribution, it allows you to use all or part of your RMD and donate that to charity. And therefore, it's no longer considered taxable income. So the beauty of it is that you're not paying a tax on it, and instead you're helping a charity of up to $100,000, which is really, I think it's a wonderful technique. But you also need to know is that if you're married and you file a joint income tax return, you're still allowed to each take a QCD of up to, each make a QCD of up to $100,000 from your IRA So, I mean, this is just something that is just really great to help charities and also to help yourself at the same time. And this,
Yep.
after 2023, the $100,000 will be indexed for inflation as well. So
All right,
that-
so that number is going to go up. So now
Yep.
we've got really a terrific situation where you have saved your monies in these retirement accounts. Now the government's forcing you to take it out. You're going to pay income tax on it. Here's an opportunity. You got now a couple choices. You have this QCD for $100,000 that can go directly to the charity. You don't pay any income tax on those traditional IRA dollars coming out, or you can do, as Mark said, the 50,000 and retain an income interest. So now there are more choices and more opportunity. Marie Elena, let's shift over to Roth IRAs, because traditional IRAs, which most people have set up, they got a deduction from their income taxes on the money they put into the IRA during their working years. So they got the benefit of not paying tax on the money that was going into the IRA, so that when it comes out, it's subject to tax. But as everyone knows, with a Roth, which came out later, another option, you could take after-tax dollars that you've earned working and put them into an IRA, so that when the monies grow, they grow tax-free, and then when they come out, they're not subject to tax as well. So what strategy would you throw out in terms of using Roth IRAs?
So, I mean, the beauty of a Roth IRA is that it allows for tax-free investment growth and tax-free withdrawals during retirement. So you don't have to take RMDs from your Roth IRAs going forward, and any money that you rolled over from that traditional IRA avoids any future RMDs. So one of the things that I like to see with this Roth IRA is that when you do this Roth conversion from your traditional IRA to the Roth, you're taking taxable income and you can offset it by giving your RMD to charity, and you could offset that income by making a charitable gift. So then you get a charitable deduction to pay, because what happens is when you make that conversion from your traditional IRA to the Roth IRA, you're going to have to pay a tax, right? It's a taxable event. So what happens then is that you can maybe give your RMD that you had to take in that year and give it to charity, and then you can take a charitable deduction to offset it. So I think that works nicely. The other thing that I just wanted to mention about a Roth IRA is that after effective 2024, to the extent that there are excess assets in a 529 qualified tuition fund that aren't going to be used, those assets can be rolled over into an IRA, a Roth IRA, for the benefit of the same beneficiary of the 529 fund, as long as that 529 plan had existed for at least 15 years. And the limit on that is up to $35,000 per beneficiary once in a lifetime. So, I mean, that's another benefit of the Roth IRA.
All right. So on a practical level, just want to kind of sum up that if you have a traditional IRA and you have the available funds to pay the tax from outside of those IRA monies, then you might want to consider converting your traditional IRA to a Roth IRA. As Marie Elena said, it's going to cause income tax, but you have the funds outside of the retirement account to pay it. That way, the funds in the Roth IRA can grow tax-free from there with no requirement to pay it out when you reach certain ages. Then Marie Elena added another element to this, which is, well, in that year when you convert, if you're creating income tax, that's an opportunity for you to make charitable gifts, which can offset that income tax. So it's a nice strategy. Let's talk about gifts of IRAs to charity upon one's demise, because the discussion so far is you're utilizing IRAs and gifting while alive.
Yeah, and this is a very easy one that you can do. Basically, what you're going to do is, as we all know, when we have an IRA, we designate a beneficiary. Very likely that our primary beneficiary is our spouse. So you can implement this technique by making a charity the contingent beneficiary. So all you would have to do is contact the financial institution holding your IRA, obtain a beneficiary designation form, and update that form to indicate, for example, your spouse as the primary beneficiary, and then the Diocese of Rockville Center, for example, as the secondary beneficiary. When you pass away, and the IRA will continue for your spouse's benefit. And then when your spouse passes away, in that example, the money will go to the Diocese of Rockville Center as the charity and will not be subject to any income tax. If you had left it to a family member, a non-spouse, it would be subject to an income tax. You can do this with part of your IRA or all of your IRA. You could even, if you wanted to, if you had a large IRA, you can make the primary beneficiary 50% your spouse and 50% the charity. It's up to you, whichever way you want to do it, or you can just have the church as a secondary beneficiary and nothing happens until after your spouse dies. So this is a way to really save taxes, because when the charity receives this IRA, they do not have to pay income tax on it.
Yes. So for example, if you wanted to leave $20,000 to your parish, and you have other assets that you're leaving to your children, if you leave the IRA to the child, let's make it simple. We have only one child, and we leave $20,000 of IRA money to the child, and they're in the 30% tax bracket. In effect, they're going to have $14,000 in their pocket. The other choice would be to give the $20,000 to the parish, where there's no income tax, and use other assets for $20,000 to the child. So instead of the child receiving $14,000 from that IRA, they're receiving $20,000 from an asset of equivalent value. So it's a common mistake that when families come to me and they say, well, we want to help the charity, and then someone, is thinking, well, we'll just put a provision in the will, take it out of my overall estate. No, much smarter to designate that IRA money and avoid the income tax for the family. Wonderful strategy. Another terrific strategy is donating appreciated securities, because if you have stock, for example, that's appreciated in value, if you were to sell it, you're going to pay a capital gains tax, and that's going to be either at the federal level 15 or potentially 20%. Could be the tax on a long-term capital gain, meaning you held the asset for at least 1 year, that stock. And so let's say I had Apple stock and it grew to a value of $20,000. And now if I sold it and liquidated it, I'd pay capital gains tax, and then I could use that money to give to a charity. Well, I can give the $20,000 of Apple stock directly to the charity and avoid the capital gains tax, which helps the charity benefit from a greater amount of money at no additional cost to me, the donor. So one of the most effective strategies for giving with maximum charitable impact and minimizing taxes is to donate appreciated non-cash assets that are held at least 1 year. Donors who use this strategy generally can eliminate the capital gains tax, as I've mentioned, that they otherwise would incur if they sold the assets first and donated the proceeds. So think about, I'm going to help a charity. Which assets do I use? IRA assets, so I can avoid income tax on those assets later. Appreciated securities, so I can avoid capital gains taxes later. Marie Elena, let's do one more.
Sure, absolutely. Charitable donations are deductible and may reduce your taxable income, right? So we just talked about that. So you might want to consider increasing your charitable gift giving in years when you expect your income to be higher. And that might be because of an event such as a capital gain or Roth conversion, which we spoke about earlier, or even like a stock option. So, if you're expecting to have a really good year and your income will increase, think about what charities can you help, because you're going to have an increased income tax. So instead of having that income tax, you can do something good with some additional monies and help out your favorite charity. So that's just another technique you can keep in your toolbox.
Okay, so we've given you a handful of strategies to consider, and I want to talk about legacy planning. And so I think about the accumulation of assets, accumulation of wealth that individuals have, and what values do they want to pass on to their loved ones as beneficiaries of their estate, and how they see those assets being utilized in the most beneficial way. And so helping charities, I mean, this country is built on charitable giving. It really is. We do so much. And you think about the Diocese of Rockville Center, you think about Catholic Charities, and all of the good work that's being done by the parishes, for example. So I would invite everyone to think about making a charity as part of your estate plan. Legacy plan gifts can be made during lifetime or under your will or by trust. And so those gifts can minimize taxes, be it income taxes and estate taxes. Think about your IRAs, your retirement plans, and insurance policies that you have. Here again, if you have the wherewithal to be able to consider making a charitable donation, then there are various strategies, as we've discussed a few of them, that can be very helpful. Some of the parishes are creating endowment funds so that if you wanted to support your local parish, you can ask the pastor, is there an endowment fund or some equivalent account or fund available that you could earmark monies to help your particular parish. For people who have more significant wealth, we often talk to them about private foundations and charitable trusts. Private foundations, it's a big step. You're making a commitment to create a foundation, a charitable organization that's recognized by the IRS. But there are many benefits that can be utilized by you doing a private foundation. So if you have more significant wealth, you might want to consider creating a private foundation, having a mission statement, which would point out what charities or charitable efforts you're going to make through your foundation. You can be involved in running the foundation as well and receive an upfront tax deduction, and others can support the foundation through giving and get a tax deduction as well. And the charitable trust, we touched on the charitable remainder trust. There are several variations of that type of trust. I think the message that I would want to get across is that if you feel like you need the income from those assets during your lifetime, so you're not in a position to give them away today, but you do want to help a charity, then you can put those assets in a trust, receive a benefit back so you keep that income stream and get a tax benefit against your other income in the year you make that gift to the trust, and help the charity at the end. So I hope these are helpful strategies for you to consider. They can be done in stages. We would want to sit down as a planner, and you should consider making sure that you have a comprehensive estate plan, that you have taken care of your family and loved ones through such a plan. So if you have not planned yet, then here are some strategies, but they should be pushed into the bigger picture of having a comprehensive plan. If you have a plan in place, we always recommend that you consider reviewing your plan and updating it as needed. So our topic today was tax strategies, but I would like to quickly mention that everybody should have advanced directives, durable powers of attorney, healthcare proxies, living wills. We touched on that on a webinar we did for the diocese. Was that, Mark, back in December?
Yes.
Yes, and it's available through the diocese or through our law firm, if you want to refer back to it, where we talked about a Catholic estate plan and how important it is to have these advanced directives and make sure that they're in line with your religious beliefs. Use of trusts, very helpful, avoiding probate, asset management, or you can utilize last will and testaments. But these are all critical documents that everyone should consider having as part of a comprehensive estate plan. I urge you to consider charitable giving as part of your estate plan if you have the mindset for that and or the